Hello everyone, my name is Radovan Vojtko, I'm CEO and head of research at Quantpedia. Now, today we will once again discuss trading strategy, and we will once again discuss seasonality trading strategy, which is, the seasonality strategies are my favorite. We have over 120 of them in our database, and today we will speak about the end of demand effect in value growth and real estate equity spreads. Firstly, what is the end of demand effect? It's a seasonal strategy in which you trade a few days before the end of demand. It's very related to the turn of demand effect, which is usually in equity indexes. Turn of demand effect says that there is a slightly positive performance at the end of demand and at the beginning of demand in equity indexes. It's very well known, and the best window for trading this effect is first, second, and third date of demand. But related effect is also the end of month treasury return. Treasuries are also affected by end of month seasonality. They have the best performance during the last few days of the month. So when you buy treasuries, long dated government bonds during the last 2 or 3 days of the month, you have the nice performance and you will capture the bulk of the returns of the treasuries without the downside risk of the treasuries, which you can see here. So you have still the nice performance of the treasuries, but here the treasuries had a significantly negative return during the high inflation. But this strategy was able to sidestep this problem and this high inflation.
Unlock the power of Quantpedia Pro with over 900 premium strategies extracted from 100,000 research papers and more than 30 quant reports. Model full portfolios, generate real-time reports and save hours of work. Quantpedia Pro, your edge in quantitative investing.
So the reason why this end of demand and turn of demand and beginning of demand effects work is because we are living in the calendar time. So it means the portfolio managers and funds and everybody is basing their decisions based on the calendar. And when you have the monthly reporting to your clients as a portfolio manager, you need to do the changes at the beginning and at the end of the month, because you want to report the portfolio that looks nice to your clients. So it means those end of demand and beginning of demand rebalancing causes a lot of the seasonal effects in the equity and fixed income, etc. markets. So that's the main reason why those trends exist. Okay, and there is one more trend, and it's end of month effect in value growth and real estate equity spreads. So we can build on our knowledge of those seasonal effects that I just showed you, and we can build the trading strategy not just using the ordinary long only ETFs like going long treasury ETFs or going long SPI, but we can build a spread. One spread is the difference between the value and growth. So we can go long value and we can short growth at the end of the month. And second spread that we can build is going long real estate and shorting S&P 500, so the overall market. Firstly, I will show you how does the performance look like. It's end of demand effect. So here we see what is the spread performance between the value and the growth, and we see that it's significantly positive for D-1, so 1 day before the end of the month, and D-2, so 2 days before the end of the month. And here we have the monthly performance over those 3 days over the average year, and we can see that there are only 3 months that we have the negative performance, and otherwise it's a positive. Here we have the distribution over all 3 days over the whole year. We see that September is the best month, but all of the months on average the performance is positive. Except I think April or except February. So it makes sense to try to capture the performance in the spread by going long the value ETF and shorting the growth ETF. And the same things work for the real estate and equity spread. Once again, here we see what is the average performance in D-1 in this spread. So it's 1 day before the end of the month, 2 days before the end of the month, 3 days before the end of the month. Once again, we see that we have only 3 negative months. One of them is April. And once again, here is the distribution over all of the 3 days or all of the months. Yeah, the best month is once again September and November, but it makes sense to hold that spread over those 3 days also for other months. So here is how the strategy look like. So when you go long the spread during the last 3 days of the month, and the question is why the strategy is working. So why there is a spread between the performance of the real estate and the US equities and between the performance of the value and growth stocks in the last few days, and why it is possible to trade them. So the answer is because of the interest rates. So the real estate is significantly sensitive to the movement of the interest rates, because when you are buying real estate, you are basically buying the buildings, and the price of the buildings is higher when the interest rates go down. So when you are buying the spread between the real estate and the S&P 500, you are basically betting on the real estate that they will be more valuable than the overall market. And when the interest rates moves, and they move at the end of the month, the spread between the real estate and the SPI will perform significantly better or perform fine. Reason why the strategy works is because it's very closely related to the interest rate momentum at the end end of the month, which is once again here. Those two strategies are interrelated. But if you cannot trade treasuries themselves, you are only with a long short fund, or you want to trade only the equities and you do not have the mandate to trade other assets, it's very good to know that there is a spread in the last 3 days between real estate and the overall market. And the same idea works, or same idea is behind why there is a performance between value and growth stocks. The value stocks are usually stocks that have a large balance sheet, and the growth stocks are usually the stocks with the lower balance sheet. So you have a significant difference between the overall balance sheet of all of the value stocks that you are buying and between the balance sheet of the growth stocks that you are selling in the spread between value and growth. And once again, the price of that balance sheet is significantly dependent on the interest rate. When you buy the value stocks at the end of the month and short the growth stocks, you will get outperformance because that balance sheet at the end of the month is recalculated, is sensitive to interest rates. That's once again one of the ways how you can find little outperformance or a little edge when you are equity long investor, also equity long short investor, so you can invest only in the equities. You don't have the mandate to buy the treasuries or other assets. You can find some outperformance by going long or giving higher weight, outweighting value stocks at the end of the month, and shorting little growth stocks at the end of the month. So this is the way how you can gain some performance. I can just give you like nice tips. So you can switch that position at the end of the month, because then once again at the beginning of the month the effect is reversed. So it means that the growth stocks outperform the value stocks in the first 1, 2, or 3 days, because there is turn of demand effect, and then this turn of demand effect is stronger in the growth stocks than in the value stocks. So this way you can easily or nicely switch between value and growth as there is a turn of demand. So at the end, just I will show the performance. So what is the performance? It's 3%, with volatility 5%, Sharpe ratio 0.4, maximum drawdown 9 is 12%, gamma ratio 0.25. So which is pretty fine for a simple strategy. Of course, you can significantly improve the strategy by better timing, etc., or using some filters, etc. But for such a simple strategy, those numbers are really good. So I hope that you like this video. In case so, please give us the like, subscribe to our channel, share this video among your friends. Just quick recapitulation. So at the end of the month, value stocks outperform the growth stocks, and real estate outperforms the overall market. And at the beginning of the month, in the first 1 or 2 or 3 days, the pattern reversed, and you have the outperformance of the growth stocks. So thank you very much, and we will see each other in the next video.
Are you interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.